Microphone check and screen share check, please. All right, good evening, guys. Ken at Tortoise Capital Nightly Strategy Podcast for May 4th, 2022. Let's take a look at the market health check first. All right, so today we had a Fed day. Yesterday we talked about the possibility of a 1, 2, 3 setup, where we said if we got a price above yesterday's high, that we might consider a risk box to the 1 bar low, or possibly the belly of the dragon, or all the way down to the 30-day low and the 10-day low and the swing low. I prefer the on a swing, just going with the statistical play of the RL10, because this extra bar here is beyond the statistical turning point, and so I just feel like that extra distance is noise. So I either like a conservative play here at the belly of the RL10. If there's an aggressive intraday move where I can have a tighter stop, then I might use the 1 bar low as the provisional low, and then convert to a wider stop later. Today was a Fed day, and the market was happy with what they said. And so that entry there gives, in retrospect, a really awesome move all the way to the top, which crosses the Z1, the skin of the dragon, takes out the PSAR dot to close right up around 430. It was enough to turn the Hull 3 period into positive territory. It reversed the RL10 to turn into positive territory. The PSAR is still down. The slope of the 30 is still down. The Bollinger Band mean is still down, but the first two members of the 5 armies here have reversed to the upside. The least surprising move tomorrow would be a gap up and some kind of follow through. Now from here, we're still in bearish market. Does it continue to rage, or does it just roll over and trap like it has in the past? I don't know. So we're going to be ready to treat the opening as a critical state. And wherever that opens, I'm going to be willing to put a risk box on it and then play the hybrid frog out of it with a tight stop in the usual way. If it breaks down, I'll be short. If it breaks up, I'll be long. And in either case, my job is to get my initial risk up and locked in so that I can gain, no lose plus dinner for 2 in either direction that we go. So that'll be my standard play for the opening after the Fed. But that's a pretty good move right there. That whole move is got to respect that. So we'll see if this is the, a swing low. It was near the previous Z3 excursion on that pinch. And when the market closes here, we're now within, 10.67% of the swing high. So we're still in correction mode, but that's what a reversal, that's what that reversal looks like if this holds. That's that first move off the bottom. So we shall see. All right, so we have the S&P here at up 3%. The Qs were the best at 3.38. Diamonds were very strong at 2.8. The Russell at 2.67. Emerging markets 1%. Even treasuries were in the green at 0.55. The only two members of our stack that were in the red was marijuana and VXX. The VIX. So let's take a look at the underperformers first, the sectors. So we have let's see, XL1, that's consumer discretionary, Brazil, lumber, the other lumber, staples, biotech, Mexico, wheat and precious metals was up 1.8, agriculture up 1%, and only marijuana was down for the day, minus 0.34, and the VIX got smashed at minus 8%. All right, let's take a look at the sectors that outperformed. All right, finance, blended commodities, materials, lithium up 3%. The FANGs, tech, blockchain, moonshots, oil exploration up 4%, between 3.5 and 4. It's pretty good. Energy, ARC Genomics up 4.34. Blended commodities, oil, crypto infrastructure up 5%. I mean, that's quite a move in oil itself to be up 4.6. Wow. It's no surprise then when Devon Energy we're going to see is up 5.38. And clean energy is up 5.25. So we also got ARC Innovation up 5.13. Now, individual companies that did really well, Ethereum, 9%, Robinhood, Bitcoin, Rivian, 6% to 8%. Coinbase, 5.33. Alcoa, big strong mover there at 5%. Tesla up 5% at 950. It's still below 1,000. We made that call yesterday. Not bad. Squarespace, Apple. So all the usual suspects. This is a rewarding of growth in crypto upon, the Fed doing what everybody thought they would do. But this is the great big reminder right here. All this daily winter, word to the wise. All right, I want to take a look at what the boys did today. Jump right into the coaching. Well, I'll tell you what. Now let's do the reports first. Get that out of the way. I want to spend a little more time on the coaching today. All right. In the dashboard number 1, we are still in bearish volatile, so beware. Getting healthier on the 2-day and the 10-day. The risk Z is still in a warning, but this is looking like it's starting to find support at that deep level of Z -2. That's not surprising. See that we've come to short-term overbought. ExxonMobil, 3M, Home Depot, Microsoft, and Merck. Amazon, Boeing, General Electric, and the Max Pains. Brazil, Metals and Mining, and the Max Pains. No dojis today. That's the least surprising finding. Lots of auto framers to choose from. Energy just crushed today. Auto framer was very good for the ETFs. And oil, energy, metals and mining, and even, the oil exploration was pretty good. It was very close to being in the green here. So I think energy is the easiest play tomorrow. Tech will be attractive, but energy is going to be the easier play, I think. The auto framer, I'd be looking at the ones that are energy related or materials like Cliff. Alcoa had a good day today. I'm expecting more tomorrow. Tesla and the Russell, I think, also. No daily squeezes today. That's again, least surprising because the move was so large. You're not going to see multiples better than 2 to 1. However, the ones that are the squeeziest, the top 3, Cliff, Alcoa, and oil. So that's pretty good. And even Tesla was kind of, is near the top of the squeeze channel. So this was not an outrageous update for Tesla, as you might expect. You might have expected that, but it really wasn't. In the Godzilla setup, there's fewer, and that's because the big rebound now moves things out of that lower, the lower bounds of the weekly and the dailies. But there's still a few. Amazon remains interesting. TFX looks interesting. And again, we've got that sorted by the Z-score. So a lot fewer choices today. Godzilla was enraged to the upside today. I've added this one. This is going to show the fireworks and the Humpty Dumpties are being added. So those are the ones where the long term is very strong. So it's greater than 0.9. All right. So you're going to see this column here. Those are greater than 0.9. The fireworks itself is one where the midterm is also greater than 0.9. So it's really rocking. All right. And then the anything that's quiet, I'm really considering as a Humpty Dumpty, where it's already started to stall. So CERN is the only one that's kind of in the Humpty Dumpty. I'm going to amend this to allow for this to be also overbought on the midterm. But as long as it's quiet, that means it's already at the stall point. All right, let's try that one. Is that any better, Nicole? Okay. The Godzillas, these are the same ones that you saw from the other charts. I'm not going to read that in again. And so that's going to get you the ones that are in extremely oversold conditions coming up from the bottom. So the final ones that are in the middle now are these fence sitters. And that's where the weekly and the daily are between 0.4 and 0.6. And then I'm isolating the ones that are either very strong or very quiet. So I want extreme volatility. So TXN looks very interesting to me. ROP looks very interesting because, and EMR because of that large volatility, but also poised to make large moves in either direction. So that's the addition for today. That'll be part of the future reports also. My intention when we get more symbols, like these are all S&P 100. If I go S&P 500, then I'll be able to take like the top 10 or 15. There should be enough in each category. I'll probably build that out in that way. The auto sniper here. So these are off of the S&P 100 also. So these are all very liquid. Boeing remains very interesting here at 3.9 on the test of the 10-day high and 1.3 on the squeeze. So most of these numbers are not as good on the squeeze as they were yesterday because today's range was so large. But still, there's some goodies in there. Amazon remains interesting. Verizon, General Electric still looking pretty good. The R6, again, this is the start point for calculating your MMRB. It's not unusual to see that you could even take half of this, as we're going to see on some sample trades tonight. So something like Procter, which is 2.4 to 1 and 1.5 on the squeeze, you could probably get away with about a 20-cent intraday MMRB and be fine. Oracle also probably 20 cents. My brother recommends 15 for Amazon. I wouldn't disagree with that. So instead of 22, you could trim that up even further. And that's looking pretty good at 3.5 to 1 and a 1. Today, a 1.0 is pretty healthy on the squeeze. The Four Seasons still being dominated by the winter. You'll notice that oil is remarkably resilient right here. And then ExxonMobil, that should tell you if you were going to focus on energy, that's the way to go, is ExxonMobil. Just about everything dominating today. I would be looking at the strength on the 10-day and the 30-day. So ExxonMobil and Devon Energy. That's why we pay attention to those longer time frames. Chevron is not bad, and Merck is pretty good. So you could do worse than focusing on those four: Chevron, Merck, ExxonMobil, and Devon. And then in the ETFs, oil exploration, oil itself, and the energy sector. I mean, that's pretty clear. This one is also standing out. Materials is above average on every dimension and excellent on the 2-day. Consumer staples is not bad. That's like in 4th or 5th position. Pretty good right there. Those are the two defensive plays worth noting. That's a pretty nice recovery. This could be the turning point in the slope of the 30. It's at a 2 sigma reversal point, so that looks very healthy. It's from those deep sell-offs that you get those kinds of powerful moves. So that's what we'd be hoping to see as swing trades moving forward. Feeling like it's trying to find support here above 410. The RL10 is at was it 4 sigma? The other times it was down in this direction, it made a very strong upside move. So this would not be unusual to see this make a strong 2 to 3 day move here the rest of this week. And I'd say even like 450, 445 certainly is in range. Far side of the river would be around 452 in range. Energy, very strong. All right, let's now we take a look at the boys here. We're going to see Tim needing to develop some belief in his techniques when we go take a look at some of his commentary. He did some bar by bar work today. He got +5 before the Fed. The high intra-bar volatility the last time. So he was working on how to manage that. And he has gained confidence in, quote, just entering on a new high and hanging an MMRB below it really pays off. Yes, it does. Trust the MMRB, get to no lose plus dinner for 2, and you have solved the main problem with volatility, which is you trying to figure out what to do. Well, that's what you do. You get these big bars like this, and you hang an entry here and an MMRB, and it starts moving up just a little bit. You get your risk out of it to no lose plus dinner for 2. And then all of the anxiety that every other trader feels about what's it going to do and what should I do is gone for you, because you don't have any risk in the trade, and you've made that much. And now your job is just to figure out, I wonder what the market's going to give me. So you start locking in pieces as your instinct tells you, comforted by the notion that you don't have personal risk in there anymore. It's now a science project. Just enter on a new high and hang an MMRB below, and I would add plus no lose plus dinner for 2. Get there. This makes all the difference. That's the single biggest psychological breakthrough I've made in the last 20 years. Just do that. Now, Tim is exploring this in his bar by bar and trading, but he's concerned that he wouldn't be calm enough. That's just practice. And trading live, small, at 1/5 of the size that you think you ought to be trading at. So if you think you should be trading with 1,000 shares with $1 risk, so you're risking $1,000, then you should be trading with $200, 200 shares with $200 at risk, so that you can use your pessimistic mind's risk and concentrate and focus on good technique when you have a small size of exposure, and then build up from 200 to your optimistic brain, which is 1,000. When you think you should be trading with 1,000, that's not your rational brain. That is your optimistic brain telling you that that's what you think. Your optimistic brain is going to try to persuade you of the largest possible size it thinks that you could tolerate. So just take 1/5 of it. Here's how I know that that's true. When we do the systems development workshop and we start off with the objectives, we say, all right, if without any constraints or any messy facts getting in the way, if you were just going to design a system, what kind of annual performance do you want? And the average number is 200% per year. That's what people want. You're not wrong for wanting that. And then we say, all right, if that's your objective, you'd like to see that, how much drawdown would you be willing to tolerate if you had a system that persuaded you that it was reasonable to get 200% per year? How much drawdown could you tolerate? What do you think that number is on average? We asked 300 traders. We said, if we could give you a system that returned 200% per year, how much drawdown could you tolerate and keep trading that system? Average number of 300 traders, 50%. Is that crazy? No, that's not crazy. That's 200 divided by 50 is a 4-to-1 kind of reward to risk ratio. That's not irrational. That's actually pretty reasonable. But here's what happens in the real world. In hedge funds, accredited investors, when that hits 10% losses from the all-time high watermark, at 10% loss, they get massive withdrawals. Massive withdrawals. So sophisticated investors, supposedly, at 10%, they're getting out of there. Now, what's the difference between 10% and 50%? 1/5. So it has to do with the order in which we ask those questions. When I ask you objectively, how much do you want? You don't have any skin in the game yet. So you say, well, I want 200%. It doesn't even feel like your money yet because you haven't made it. But once you're an accredited investor and you've made that money, it's yours. The high watermark, you think that's the minimum level that it should be at and that it should keep going. So when you experience even a 10% drawdown from that, that hurts 5 times as much as the theoretical 50% drawdown compared to your 200% gains. So that's why people start pulling out at minus 10%. And that's why hedge funds that are down 8 or 9%, they shoot the moon. They just said, well, why not? I'm going to go ahead and make a big, large bet because if I win, I'll win big and I can get out of the hole and they'll be happy. But if I take another 10% loss on that trade, well, they were going to get out anyway, and I'm going to lose my fees. So that 10% drawdown is really significant. Here's the other thing. If you got $100 in the account and you're down 10%, you're at 90, and it takes 11% gain to get back to 100. But if you're down 25% and you're at 75%, you got to have 33% return on 75 just to get back. So the more you start losing, the harder and harder it is to make up the difference given the reduced capital base. So 10% is not an irrational number. Now, why do I say all that? I say all that to make the following point. That when we say, how much do you want per year, and ask that as the first question, they say 200 and I can tolerate a 50% drawdown. But if you reverse that and you ask them in that workshop, we're going to design a system. I'm not going to tell you what the system gets yet, but how much of a drawdown would you be able to tolerate before you start asking questions and saying, hey, I really don't really trust it? It turns out to be about 20%, which is still even more optimistic than the 10%. So I just use the 10% as the real risk tolerance. So if you had some kind of histogram and you said, hey, here's the normal, I would say in the middle is this rational mind that is driven by math. And that's our decision-making brain. And then there's some optimistic brain over here, which says, oh, I'm thinking 200% because I've read the marketing material and I can see all that. So I'm thinking 200%. And then over here, there's your pessimistic mind, which says, look, dude, 10%, and we are out of here. Because I don't know about all this other stuff, this rational and this joyful person over here. I'm living in the world of the rat brain and risk and uncertainty and fire and things that go bump in the night. And that's what kept us alive during the Paleolithic era when we were walking the plains, whenever that is, right? So the difference between the pessimistic mind and the optimistic mind is a factor of about 5. So my hypothesis is that you think you're making decisions from this rational brain in here, and you're thinking, well, I think I could trade $1,000 of risk. That's really the optimistic brain that's thinking about the rewards, and it's trying to persuade the rational brain that, yeah, you could tolerate that maximum amount of risk. And then I would say, use your pessimistic brain for what it's really intended for, to protect you from ruin. And if it's 5 times more risk averse than your optimistic brain, and you think you can trade $1,000 of risk per trade, 200. And then once you're making money on $200 risk per trade, increase that to 250, 300, 400, 500 on the basis of evidence of forward traded results, and use that evidence to persuade your rat brain that you have rational reasons for increasing the size of your risk. You let the portfolio grow and generate evidence and use that to drive the risk per trade, not the optimistic brain. Here's what happens with guys that believe in back testing too much. They will spend all their time in the laboratory coming up with back tests until they think they have a perfect system against all of the back tested data, and then maybe even some out of sample. And then they put real money on it and it suddenly stops. And so after they've done all of that back testing, they go in with the maximum optimistic brain and they start trading it at maximum exposure. And if there's any kind of underperformance, they immediately trigger over into fear because, hey, this thing is not performing the way the perfect back test said that it should. So I don't even go there. For me, the back test just has to be good enough to trade it forward, and let me trade paper trade and then trade 1 share or $1 to see what it is like trading forward instantly, and trade it 50 times for the dollar at risk. And let me see some actual numbers of forward. And then I'm going to learn something from 50 trades with money at risk and skin in the game. How do I feel? How does it trigger? What's the difference between the simulation and the back test and the forward trade? That's what Tim is talking about in here. To be honest, he says, I would not have been calm enough during the high volatility to come close to the simulated result, including all trades with all the calm to frame my next trade. You know what that tells me? You need to be working on the zero state. You need to get in there and start trading live with $1 at risk and just get over it. Experience the gains and losses of real money at a level that you can easily tolerate. And then if you're scared of snakes, start handling snakes, non-poisonous ones. And then start with $1 at risk, and then 10, and then 25, and discover what is the threshold at which you start feeling nervous. That's where you're no longer prototyping and you are at low level production. That's the number that you got to discover, and then back off one step so that you can trade at the maximum size at which you can execute rules routinely. Build the proficiency like you're doing, Tim. That's proficiency. You got almost 250 trades. You've got skills, but you are seeing a distinction between the paper trading forward and the bar by bar. You're seeing a distinction between that and the real world. It's because you're thinking about real money, and you need to think of real money starting with $1, and then $10, and then $25. The longer that you wait to do that, the more pressure you're going to put on yourself to hurry up and get large in order to make up for the time that you spent investing in bar by bar and simulate. Get in there and trade. Get in there and trade. Find out. And then work on your zero state. That's what you need to be doing, in my opinion. You got a live scrimmage against a real team that's trying to beat you. And you got to, it's more about your psychology. You're going to figure out pretty quickly within 20 trades that you can trade live in the same way that you are trading right here. Now, if you need more persuasion that these rules work in abnormal markets, 5R before the Fed, and look at all that volatility. And then when it shapes out, 17R, 22 for the day, standard trading practice, managing risk, get to know lose plus dinner for two, trade one lot. Don't worry about adding positions until you're bored. So 22R for the day. I leave it to you guys to study his numbers, but that's what happens in Fed. You just get more volatility, and when it breaks out, you know how to trade that. This is standard work for abnormal conditions. It's not incredible. It's not amazing. It is simple, professional, attention to detail, know your patterns, trade your patterns, get over it. Trade it at a level of risk that you can handle professionally. It doesn't matter what the actual number is. What matters is finding that number and then building on it. Hey, I can only do 2 push-ups. I'll never be strong. Well, how do you think you're going to get strong? You do as many push-ups as you can, and then you keep doing them, and you'll get stronger. It never fails. Here's my brother. With the simplified sniper framework, all he's got.
Hey, Ken.
What?
I was just gonna that sidebar of I was telling Nicole about the first trade here.
Yeah.
It's $100 at risk per trade per entry.
Yeah. Yeah.
So at the end, I'm at $400.
Right.
That's how. I just want that. I didn't mean to interrupt, but I just wanted to let you know that's when you see multiples over here, like at the 1.0 plus 1 and the 1.6 minus 4.
Yeah.
At the other side, that's what that is.
Okay.
Sorry.
Simplified array, PSAR, Dragon, RL10, MMRB, and nothing else. It rolls over, PSAR flip. He gets through the dragon. He's short. He's got 2R in hand. Second position, collapsing dragon. Third position, fourth one, instant reverse, instant out, 11R. Scratch, small loss, small win, medium loss, nice win, nice win, nice win, 14 trades, 13R. Standard work, Amazon, 2-minute charts, no overnight risk. The dragon and the PSAR are your friend. I'm going to tell them, where were you here? And where were you there?
I was,
I don't care where you were. That was a rhetorical question.
Yeah.
I know where you weren't.
wasn't trading.
You don't have to trade all the time. You're supposed to tell me to shut up. Luke, 3.5 today. Good scratch, quick loss, quick paid, should have been out here. Good point. Quick loss. The one that pays. Quick loss, pays. And this one just gave back way too much. Scratch, loss, nice win, and still giving back to me. Hey, stop drawing the orange dots. Start putting a stop loss where you're going to end up drawing that pink dot or that orange dot, because you gave back about 4. So this should have been around 7. Wojcik on the WMB3. Oversold, uptick, buys it, gets paid, too slow getting out. Oversold, uptick, enters, gave back too much. Oversold, uptick, enters, got paid, that's better. Missed the collapsing dragon. Oversold, uptick, should have been here. Still pretty good. Excellent exit. Good re-entry on this little uptick right here. Gets paid, 4.5R. Nice work. Review the bar by bar for technical instruction. My brother. Hey, how many days is this in the market? Probably 3, 4.
That was my day today.
Oh, today. So this is a 1-day production schedule.
Yeah. 50 trades today.
50 trades, best one 6.5, worst one -1, 26 wins, 22 losses, so 5-4. 1.2 to 5, so that's about 2-1, 2.5-1. So that's a 12-4 or a 3-1 payoff ratio all day. All day. Good system quality number, stable around 50.5 expectancy. No losses worse than 1. Good work. Add gas. Griff. Here's just the COTA 2 gains 2.5 today. So low, higher low, quick out. This is the COTA 2 to the downside because he has a high, a lower high. So this is the COTA 2 entry to the downside. Remember, the COTA 2 works in both directions. So he gets paid. Now you have another lower high. So he gets the COTA 2 entry, gets paid. This rolls over, quick exit. This one is still below that. So this is still technically COTA 2, gets paid. Good scratch. Good quick short. Now he's got, I don't know if I'd call that a COTA 2, probably close, worth a shot. Gets paid, scratch, Big pay, 2.5. Good work. When he integrates all of the patterns, so this one would include the CD as well and the SSC. That bumps up to 3.6. So he gets some extra trades in here, and he's carefully got them all marked so you can work on those things. It's worth it. He's not had a losing day in the last 2 months. Got to on the day, if you take this as a daily production. So here's the point I want to make. So when he does his daily work, there might be like 5 or 10 trades in here. And if you take the individual stats, it's pretty good. But when you take the entire daily box as a single trade and look at the results, no losing days, and the system quality number is greater than 6. That's the kind of work that you want to be able to do. You're mass producing quality, and it's being sold in the market for good returns. That's what gets you consistent numbers, and that's how you get a high system quality number. Bought some original artwork from a well-known comic artist on Godzilla, from the Godzilla and Kong series. All right, so here is CLF. This is before the Fed. Well, you shouldn't trade before the Fed. Okay, what if you did? So here's CLF. This was on the list yesterday as a Godzilla and a possible follow through. His R6 is 45 cents. So this is 40 cents. This is 20 cents. And this is 10 cents. All right. So if you were to come over here, 10 cent, this little visual trading box, you're going to get most of the noise on 10 cents. So breakouts become interesting in the same way that this would have been tradable. Okay. So we're going to take a look at this one. This was an SSC signal on TC2000, gave me an SSC alert on a symbol that is on my top 5 things to trade every day. So I just come over and look at it. I see, oversold and an uptick. So I come up to here and I draw my little green dot. Check or hold. Everybody understand the setup? All right, so keep in mind the size of these risks. What I notice is this is the low of the day, and it held support at the low of the day. So if I'm going to get in here on the next box, or on the next ticker, right? Like I should, if it goes up. If I am using the R6, then I'd be hanging a 40-cent risk box as 1R, and I would, bring it all the way down here. And then if I was using that much of a risk, right, then that's how far I would have to let price work against me in order to take a 1R loss. So to review yesterday's lesson again, a violation of the daily low is all the confirmation I need to know that this thing is not working. Because if this is going to work, what should it do right away? It should work. If it's going to work, it should work. So if it doesn't work, I'm not going to stick around any longer than the low of the day. So this is the price at a minimum that tells me this thing isn't working. So the hypothesis of the trade to the upside has been disproven. So it's not in my rule set to let it fail a full 1.0 R. The 1.0 R is established so that I don't have too much risk on my worst possible exit. I want my worst possible exit to be tolerable, not enjoyable, but I want it to be tolerable. So if this is going to be my risk now, if that's going to be my entry right here, I can, if I don't want to use the red, I mean, you could still use the red and get out at the red line, but for position sizing, I might use half of the R6, which is 20 cents. Or I might use a full 10 cents, even 10 cents below there. Why wouldn't I be willing to have 10 cents for position sizing? So let's look at it this way. And this is where your rational brain is going to do some math. If I decide to use 40 cents, my R6 MMRB, and if I'm going to risk $400 per trade as my standard risk, if I go with a 40 cent 1R loss, then that means I can have 1,000 shares. So if it moves 40 cents against me, then I lose 400 bucks. Check or hold. If I use 20 cents, which is this orange box, even that is quite a distance below the violation. So even if I put my risk at 20 cents and this thing moves against me and maybe I hit the exit button here and I get a little slippage, I have a little bit of wiggle room. I'm not going to take a full 1R loss, but at 20 cents, I can have 2,000 shares. My risk is still $400. Check or hold. If I use the 10 cent risk, then my exit would be here, which is still below the low of the day, and it gives me a little bit of wiggle room. Then I can have 4,000 shares. So here's my quiz to you. Now that you know what the trade frame is, that you're going to get long if this breaks to the upside. This red line is the price that gets you out because it proves that this wasn't working. Do you want to use, would you use a 10 cent, 20 cent, or 40 cent risk? This is 1, 2, or 3. I used 20 cents. I like having the extra buffer. As long as you can manage not to take a full R loss, then you're okay. Now, to the upside, if this thing does work, and if my risk box is this, if I get to here, I'm holding 2R, and now I've made 800 bucks if I use the tighter risk box. If I use the 20-cent risk box, that's only 1R, and now I'm only up $400. A move back into this range is not irrational. Look, 1, 2, 3, 4, 5 times in the last hour, it's moved to that level and held support. So I'm entitled to believe it could get that high, and it would take a strong move to get through there. So that is sort of my maximum reasonable gain for this moment. If I use this one, I have a clear 2-to-1. If I use this one, I have a 1-to-1. I might still tolerate that. If it gets me out, this is about a -1R. If I use this one and I get out right here, I'm down a 1/2 an R. But at some point, the R also translates to how much gain you want to make up in here. So if you want $800 out of that trade, you got to put up 2,000 shares. If you are satisfied with $400 in a 1R, you can do it on 1,000 shares. That is trader's math. When you use a standard risk box, use that box all day. And then you have standard lot size, standard distances, and you can compute this stuff pretty quickly and not have to think about it in the heat of the day. Trader's math. So now that I've said that, decide what size risk you want. 10 cents, 20 cents, or 40 cents. Just make that note, put it in writing so that you can own your result. Would you agree that we just entered? The answer is yes. We just entered. If you're using 10 cents, you're in this little yellow box right there. You know, your exit point is still that thick red line, right? But your 1R risk is that yellow box. If you're using 20 cents, that's your 1R loss. But your stop should still be right here at the red line. Check or hold. Good. If you were in the yellow box, you'd have been white knuckling that. If you were in the orange box, it's just noise. It's not, it's a third of your actual R. So this has to do with your blood pressure. Would anybody disagree with having the stop now up here? At least. When you're learning to trade this way, I'd have these boxes drawn so that you can just build in the psychology visually until you just learn to see these things automatically. So the green box is what I've locked in. This blue box is what I've given back from the height. And this yellow box in here is kind of the negotiation space, right? Yeah, you could put the range stat on there too. that wouldn't hurt you. So now we're going to start playing this game. Boring. Okay, where do you want your stop? 1, 2, or 3? And again, at this point, I don't even care what your initial 1R loss is, because now that doesn't even matter at all. Once you are no lose plus dinner for 2, you don't care what the theoretical thing is, because this is now becoming the trade that it is and no longer the trade that might be, right? As you're getting more information, it becomes more and more the trade that it is. And all you need to decide right now is not how much money, not that. Where is my stop? 1, 2, or 3? 1 is closest to, okay. So I see a lot of 2s. I wouldn't disagree with the 2. You know, with a 2, you've locked in that much, and you're giving back about half. Now you're all lucky. Hey, so here's the other thing too. You know, we're showing this as we're revealing the whole bar, but really, as that thing starts going up and you were at 2, you might have been locking that in. And so I would say a 2 is probably there now. Or maybe right here. So maybe 1, 2, and 3. So let's give 2 halfway up the stack right there. So I'm seeing 2s and 3s. If you're a 2, you've locked in. Now, if you were a 10-cent guy, right? 1 is a full R gain. If you were the orange box, you're at half an R. I'm not even going to tolerate a second position until, let's see. Probably something like this. So I'm just going to get that out of my head. Your mileage may vary. All right, so you've locked in your gains, or you've locked in your stop. If you were a 2, you might have gotten ticked right there. If you're a 1, you're out. 3, you're still in for sure. If you were a 2 and you got ticked out, that's your trade. And that's 1R, approximately 1R. And then your question should be, what is my average win? What is my average win? if my average win is 0.7 and I just pulled in an R, I actually got an above average win on that. That's not bad. Yeah, Tucker notices that this would be a 1, 2, 3. Yeah, kind of, but I think of the 1, 2, 3 really as after a sell-off and then a reversal. This is not really a reversal. That's really just a continuation pattern. So I would not normally call that a 1, 2, 3. It's just a higher. I mean, you like higher lows and higher highs. So that would actually say if I got ticked out at the red line, at 2. And if this was my focus, I'd probably be getting in here or here on confirmation, right? So those of you that are in 3, now we're going to say if you were holding 2, it just didn't quite tick you out. So, okay, you're back in. And now your stop is probably down here around 3, at 3 or 2. I'm going to say 1, 2, or 3. If you're in that trade, either from the original one or you re-entered at the green dot, what is your stop? 1, 2, or 3? 2 feels correct to me. So maybe something like that, like splitting the difference. So now where's your stop? 1, 2, or 3? Tucker, some folks re-entered at this. Some folks that got out at the red dot re-entered here. In the advanced course of this thing, we would say, well, even if you didn't get out there, that's an interesting place to get a second position if you have a really tight stop. But what I said, I had committed just personally that I'm not going to get a second position personally until that blue line, because I got other things that I'm attending to, and I just made a command decision. I'm not going to, but your mileage may vary. We've shown enough techniques here of why, as you begin to feel this thing leaving the station again, getting a second position and with a micro stop is a way to quickly get your second position on. All right. So, yeah, 1, 2, or 3, put your stop in. And no matter who you are, no matter who you are, you're out somewhere at either 1 or 2 or 3. And no matter what, you didn't lose any money on this trade. You might have gotten this one or this one or this one. And you might also, if you were the more conservative guy, you might have gotten this or that. In any case, this was a good workmanlike trade. So I'm going to come back to work. When I exit a trade, I just come down and check, especially if I've already had one re-entry and there wasn't much follow through. I just come back and go to work. Check the next job. Oversold. Do I have an uptick yet? No. And that last little bar is down too. It closed poorly. That's not good. Do I have an uptick? No. Do I have an uptick? No. Do I have an uptick? Nope. Do I have an uptick? Nope. Do I have an uptick? Yes. Yes, I do. So that's the bar that closed. So would you agree that this green line right here is above the peak of that bar? That's going to be my entry level. Would you agree? And if I just pick this arbitrarily, that's the smallest manageable risk box, right? But if, as you start looking at this thing, you say that almost encompasses the whole move from the very peak down to the bottom. Do I really want to take much more risk than that anyway? Probably not. So maybe I'll just put that on there. And then if you said, no, I want that 20-cent risk box, then I would say I'm not opposed to that idea. In which case you'd have that double stack would be 1R. Okay, fair enough. That's for you to sort out. But no matter what, if this thing goes below here, I'm not letting it go below that red line. Can we agree on that? I will not let it go below that red line. So at some point, you just have to ask yourself, does this little extra box from the red line to the bottom of that risk box, does that give me enough protection against slippage and all that other crap? Probably. Depends how liquid that thing is. That's why I like trading the very liquid, frequent traders with continuous signals. So you decide, do you want risk box, the tight or the medium? We don't have an entry yet. Do we have an entry? Yes, we have an entry. Yes, we have an entry. Do we have no lose plus dinner for two in the very next bar? Yeah. You know how soon I move that thing from here to here? As soon as that thing opened, it sold off a little bit and then started going up. When it gets right about there on the way up, that's when I move that to no lose plus dinner for two. That's how fast I want my risk out of there, because then my monkey and now my fireman is done. Well, you don't know what, you might have, if you moved it right to there, you might have been ticked out by the fact that it sold off quickly. Because remember, this is a 1 minute bar. But clearly, once it starts moving up this stack, somewhere as it's moving up while this bar is open, somewhere in there, you can rush that thing up to here. And then it comes back and holds here. And now the bar has closed. And now your decision is, Probably something like 1, 2, or 3. And then you have a decision to make. What am I going to do with that one? If that's like the new high, if that's the high of the day, maybe I'm thinking about that. I don't know. If that thing goes through the blue line, I'm going to add a second position right there, and I'm going to jump the stop like right up to there anyway. I might have gotten out here. If I did, I'm getting back here. Would you agree with that? I'll let you decide if you got out at 2 or at 1. But now that we're here, one, 2, probably 3. Make your decision, 1, 2, or 3. Marius is at 2. Okay. See how that goes. So that bar's not even closed yet. The bar is still open. Now, my brother, you told me you don't move your stop until the bar closes. Really? Really? If you saw that, you better be moving your stop to 1, 2, or 3. Maybe if I just bring my little wrist box and hang it off the top. See, even that is the 10-cent wrist box is already too far away. You know what I mean? So 1 is going to keep most of it. 2 keeps half of the gift box or the gift bar. 3 keeps a third. What do you like? I might just buy another one with a stop at 1. Something like that, maybe. Or a stop at 2. That's if you hadn't been stopped out, that could have been the third position. But it's at least a second position. That's the argument for getting the second position on quick with a very quick stop. I love that. Because now I have no hesitation about getting the heck out of it, excuse me. And I gave myself a chance for a big win. So if you were at 1 or 2, 2 is not quite out yet because it did not tick. So if you were a 1, excuse me, if you were a 1, you probably got that trade, from here to here, and maybe a second one from there to there. So that's a pretty good day at work. My brother's still in. All right. Let's see about that. Now, if you got out, would you get in here? Or here? I would get in at one of those green lines. I would get in at I would get in on that green line right here. If I'm out at 1, I'm back in at the green line. And if I get in at the green line, I also get out when it fails down here. So that's a quick scratch for me. Now, my brother, where is your stop? Was at 2. Where's your stop now? So your stop is still at 2. Okay. If it was me, I'd have 2 like right there. Oops. And there's no way I'm sticking around longer than 3 under any circumstances if I'm still in. You're still in. You're out at 2. 3 is still in. 3 is out. So now I'm going to come down and go back to work. Now that's an uptick. You might be interested in that as a cotta too, since it was already a pretty strong move. Who wants to go look at that to see if you want to get in? You'd be right. So that green line is pretty persistent. So as I'm watching that, I can play this one. This would also now be a 1, 2, 3 entry. If you did not get in at 3, would you get in at 2? So that's a good question for you. So in the cotta 2 that Wojo's doing, that's actually an entry. So one of the reasons that we put the range stat on there is to find out how large, the upside move can be. This is nothing. The range stat on this thing is $3. And this big orange box from the low of the day is 40 cents. It can move 7 of these red boxes intraday. 7 is how big that move can be. So I want you to think about the power of when you're at an all-time high on the intraday and you get that quick sell-off and then a universal reentry or a new high of the day. Remember what Tim said, hey, new high, get in and put a risk box on it, slap the MMRB on it, and just go with the standard, put a chip on it and go. All right, here is a symbol. This is US steel. The R6 is 40 cents. This is a 40-cent box. This is a 20-cent box. This is a 10-cent box. Here is a, let me draw the arrows. Oversold, uptick, entry level, check or hold. Now, would you agree that we're not going to stick around any longer than that red line, no matter what? So that's what a 40-cent box looks like. That's what a 20-cent box looks like. And that's what the 10-cent box looks like. The 10-cent box feels a little tight to me. 20 cents feels approximately correct, but I could live with the 20 or the 40. And so that's either going to be 1,000 shares or 2,000 shares on US Steel. So we've got the uptick. We are prepared. In. Arbitrarily half. It's already moved more than 1R. Should I lock in 1? Lucky. Good to be lucky. Which stop do you like? Now, this is interesting. Oh, Eddie says, hey, what about a second position here? Let your conscience be your guide. But that's pretty much the high of the day right there, isn't it? Oh, we don't know because it's 2:30, but that would be sort of a local. So if you were would you get a second position at the blue line, at a break above the blue lines? Let's say, like right there. If you would put a second position on at 4, then I'll just tell you, you should put it on now and put your stop at 1 or raise 2 to here. Because why not? If it's going to work, it's going to blast through 4 and just go, right? It's just going to go. Or if it doesn't blast through 4, it's just going to fail anyway. So there's no risk. Put the second one on, put your stop at 2, and it doesn't matter. Because you're only risking a third of an R at 2. Who cares? That's the why not entry. Even that feels slow. I should have had that thing right here, all right? Can you see why that third would be awesome? We're just going to put 2. Why not? It's well clear of 4. So don't do that. Oh, man, don't do that. What are you going to do? I'm going to raise my stop. That's what I'm going to do. 1, 2. That's the sound a trader makes all day. Nah, too soon, right? No. Darn. I mean, that could have had 4 positions on by this time. You know, what you should do on that, instead of monkeying around with this, you should be, when you are that comfortable, you should just increase the positions, the dollars at risk on the original trade by 25%. That's how you do this. Instead of over complexifying, instead of risking $400 per trade, increase your dollars at risk to $500. Trade 1 position as a percent, and then trade $500 as a percentage of your portfolio. I mean, you can't do that live on this trade. But once you find yourself eagerly putting second and third positions on and stuff like that, you might consider just slow down, Slick. Just slowly increase your dollars at risk per trade on future trades. on the basis of evidence. That is a good problem to have. Don't you want to have that kind of problem? All right, Bill, so you want a third position on there? All right. I think it was like right here probably. And your stop is at 2. Okay. Hey, do you think you can handle that trade? Do you need more information than price to just handle that trade, just the way we did it? What I was saying, oh, that was right after the Fed, and because of reasons, there's volatility. So what? Doesn't matter. Trade the price. Would you get long again at the green line or the second green line? At 4 or 5? Do we have an uptick? So nothing happened after that long period of digestion, but now we have a potential entry. We have our standard entry right here. So just wait. This is 1 minute bars. Let the thing digest. You had 3 positions in there and you crushed it. Hey, this last trade right here made 1, 2, 3 on the first one, 1.5 on the second one, half on the third one. That's a 5-hour trade. Do you think you could just take a break for a moment and just relax? Yes. Then go back to work. Oh, overbought. I'm sorry, oversold, uptick. This is just the normal breathing of the market. Do we have an entry? We have an entry now. Standard work. But I'm not going to let it go below that red line. Check or hold. Science project. Boring. Do you want that trade? Well, the answer is, did it make money? Then the answer is yes. I want that trade. Would you get back in at the green line? So to be honest, we got to come back down to that the swing low of the bar where we exited. So we're not out of that thing yet. No lose. Boring. Science project. Do you want that trade? Yes, it made money. We're probably running out of daylight. It's after 3:30. So you'd be entitled to just call that a day. That's about 6R. Do you want 6R? I do. Oh, crap. We're just going to call it a day. Crap. Hey, new highs of the day. Because why not? You just find the previous little swing low, slap your little execution stop on it. As long as it's closer than the MMRB, which prevents you from a disaster, you probably get this exit 1, 2, 3. You know what I mean? So that's what that looks like, bar by bar. The one thing that Kong and Godzilla don't worry about is worrying. They do not worry about stuff. That would have been another couple. Yeah. So did you want 6 or 8? They do work. Relentless. Channeled fury. Doesn't matter that it was a Fed day. Does not matter. Doesn't matter. All right, Nicole, what's your question? So you're going to ask me a question, and then what I'm going to ask you to do is, what do you think I'm going to say? And then write that down. And then write down why you think I'm going to say that. Oh, okay. Yeah, $200. All right. So, yeah. So $200. That's fair enough. Because that's a math question. I thought this was going to be a philosophy question. I'll answer math questions. So $200 risk per trade. Standard risk. Why? Because $200 represents some X percentage of portfolio. Small. 1/10 of 1%. Why? So you don't care. So that you can trade 1,000 times. Each trade is the first trade of the next 1,000 using this system. So there's all these little trades, each one going to be executed correctly at a trivial amount of individual risk, but standard risk. So $200. This was a 40-cent risk box. This was a 20-cent risk box. This was a 10-cent risk box. Which one did we use? 40, 20, or 10? We used 20. So if $200 is the standard risk per trade, the hypothesis on this was that a move beyond here invalidates the trade. So I can't let it go further than that. So I can use 20 cents. I'd take $200 divided by 20 cents, maximum position size, 1,000 shares. So trades are performed. What was our net for that series? 6R or 8R? Call it 4R, because you were not going to get all fancy and shit in here stuff. At 4R, at $200 a trade, what was your net for the series? 800. Because you made 4 times your risk capital. 6R is 1,200. 8R is 1,600 on a standard risk, standard shares, standard risk on every trade. You always know what your position, your standard position size is based off of standard risk per trade and the MMRB. Now, how do you get to $200? Do you think you could trade with $200 right now? Do you feel comfortable? Okay. So what am I going to tell you to start at? 40? So if you're going to start at $40, that's 1/5. Now, if you had a 20-cent risk box and you're going to risk $40, how many shares can you buy? $200. Because at 20 cents of risk, if I was risking $20 and 20 cents of risk, I could get 100. But I'm risking 40 divided by 0.2 is 200 shares. 80. 200. No, 40 divided by 0.20. So 40 divided by 20 cents is the same as 40 divided by 1/5, which is the same as 40 times 5 is 200 shares. Or you could just say 40 divided by 20, 200. Or you say this way, if I was going to risk $1 and the risk per share is 20 cents risk per share, if I was only risking $1, how many shares could I get? 5. 5 shares per dollar of risk. So if I'm risking $40 at 5 shares per dollar, 200 shares. Yeah. Okay. Clear? So then what I'm going to tell you is, after you have traded with this geometry and these setups, and you've got 30 trades at $40 risk per trade, and your positive expectancy, you put the stats on it. After 40, You don't change any of the architecture, but you increase that to $50. You just increased your possible returns by 25% because you increased by 10 on a base of 40. When you can handle 50, then go to 75. Or I would go 80. And then 100. Oh, I couldn't do 100. So go back to 80, get another set of 30 positive expectancy. And so you start slowly growing towards your full production rate of 200 by starting at 40 and then incrementing up. And each time you increase that risk a little bit, you're checking to see if you can manage your inner monkey and don't care about all the other noise and just trade the patterns correctly. And then you increment the risk, and you never change the architecture and the geometry of the trades. Never. Because you have accumulated evidence that architecture works at 40 and 50 and 80 and 100. And all of those things are additive. All of the evidence that you're accumulating says that architecture and trade geometry is all working. If you said, no, I'm going to go to 200, and now instead of a 20 cent, I'm going to use a 10 cent because I doubled my risk. You have no evidence that says at the 10 cent level of risk that you can manage those trades. So you're starting over with the maximum amount of risk and no evidence. Doesn't that sound incorrect? Yes, it sounds incorrect. So what you do is you simply increase the dollars of risk per trade off the same standard work, same standard frame. And you don't ever change that. You just increase the dollars at risk per trade as a percentage of portfolio. Okay. All right, that's enough of that.